As in my previous video, I talked about the different countries have the different competition rules regarding the income tax. So, national tax assessment system also affect relatively tax burdens. Simple tax rates are not sufficient for assessing the tax burdens. The how the tax is being computed, that is important. That means method of computing the tax is also very significant. These also affect tax burdens. Several systems are there, but in general, two methods are predominant. Now, one is classical system. Under the classical system, the corporate tax is levied at corporate level and shareholders level. That means any income earned by the company that is subject to tax, then whatever the dividend is being declared to the shareholders, that is again taxable in the hands of shareholders. So shareholders are taxed either when the corporate income is paid a dividend or when they liquidate their investment. They should not be taxed twice, but under the classical system, they are taxed twice. When a corporation is taxed on income measured before the dividend are paid, shareholders has dividend, then obviously, as stated, they are taxed twice. This system is generally found in Belgium, Luxembourg, the Netherlands, and Sweden, and in many more. So just try to see and understand the example. Corporate income is, let it be 100 rupees. Income tax rate is taken to be 33% and dividend tax is taken to be 30%. So income tax is deducted 33 rupees. So net income after tax or after corporate tax is 67. Let's presume that the total income is subject to distribution of dividend. So dividend will become 67. Now the personal income tax or dividend tax, that is 30% on 67, that comes to 67 multiplied by 30 over 100, that comes to 20 rupees 10 paisa. So net amount to shareholders will reach 67 minus 20 rupees 10 paisa, that is 46 rupees 90 paisa. Let's see the old tax burden. Corporate tax 33, individual income tax or dividend tax, that is 20 rupees 10 paisa. So total becomes 53 rupees 10 paisa, more than half. Then integrated tax. Under this tax system, corporate and shareholder taxes are integrated so as to reduce the double taxation burden on the shareholders. So as to reduce the double taxation burden on the shareholders. A system of tax credit is introduced. Tax credit is a common variant of this system. A tax is levied on the corporate income, but a part of tax paid can be treated as tax credit against the personal income tax or dividend tax when dividends are distributed. Undoubtedly, the corporate tax is being charged, but a part of it is given as a credit against the dividend tax, so their tax burden is reduced. This system is quite prominent in Australia, Canada, Mexico, and many European countries, including France, Italy, United Kingdom. Example, tax credit is 25% of corporate tax. Again, the corporate tax is 33% and dividend tax is 30%. So let's go through income of the company, presumed 100, income tax 33, net income that is 67 after income tax. Again, it is presumed that total income is subject to distribution of dividend, so it comes to 67. Add tax credit, that is 25%, given in the top in bold letters 25% of 67. So that comes to 67 multiplied by 25 by 100. It is 16 rupees 75 paisa. Then the income is grossed up. That is 83 rupees 75 paisa. Then income tax liability is 30% on 83 rupees 75 paisa. That is 83 rupees 75 paisa multiplied by 30 over 100. It comes to 25 rupees 12 paisa. Minus tax credit from the direct income tax liability in the hands of shareholders or dividend tax, 16 rupees 75 paisa, which is calculated earlier. So net tax will be 25 rupees 12 paisa minus 16 rupees 75 paisa, that is 8 rupees 37 paisa. Now see the overall tax burden. 33 rupees corporate tax, 8 rupees 37 paisa is the dividend tax. So the total tax become 33 plus 8 rupees 37 paisa, that is 41 rupees 37 paisa. This example or illustrates that a partial imputation in which the double taxation is reduced but not eliminated. We can also think of the total exemption, total credit.